The United States is currently on the brink of a dire credit crisis, unleashing a financial tsunami of bankruptcies that is sending shockwaves across the nation. According to recent figures, there has been a staggering 216% year-over-year increase in corporate bankruptcies in the first half of 2023, marking the highest surge since the 2008 financial crisis. Major banks like Goldman Sachs and others are sounding the alarm, warning of the impending catastrophe as the Federal Reserve's policies and rising interest rates create a perfect storm. As banks tighten their lending standards and businesses struggle to repay debt, millions of Americans could face devastating job losses. Consumer spending is already showing signs of decline, and household debt is outpacing income, creating a financial strain that's unprecedented in recent years. The most recent data show 2023 corporate bankruptcies rising at an alarming clip. 236 bankruptcies were recorded through the end of April 2023. Credit crunch and economic downturn. The recent collapse of Silicon Valley Bank and Signature Bank due to a tidal wave of withdrawals has sparked fears that regional U.S. banks will also run into trouble. Depositors have rushed to move their funds out of regional banks and into money market funds, which typically offer larger yields and are perceived as safer than uninsured deposits. The deposit outflow has stoked concern among investors that regional banks could be hit by bank runs, and wary lenders might pull back to make sure they're not too exposed, leading to a credit crunch. Corporate bankruptcies are on the rise, and so are consumer debt delinquencies. Delinquencies rose across all days past due categories on a year-over-year basis, jumping from 0.16% of loans in 2022 to 0.25% in 2023. Timeline of United States banking crises. Throughout the history of the United States, we've seen a series of banking crises that have had far-reaching impacts on the economy and people's lives. From the Great Depression in the 1930s to the savings and loan crisis in the 1980s and the more recent 2008 financial meltdown, these events have underscored the importance of being prepared for potential financial crises. In early 2023, a new crisis unfolded as investors initiated massive capital outflows from banks like Federal Reserve Bank and Signature Bank, triggering early signs of a liquidity crisis. In March, Silvergate Bank announced its closure due to withdrawal demands, while Silicon Valley Bank reported a loss of $1.8 billion as it sold bond-specific investments to meet withdrawals. By mid-March, the crisis extended to Europe, affecting Credit Suisse and other European banks. In April, First Republic faced escalating challenges, suspending dividend payments and experiencing a substantial deposit decline, while regulators took control of the bank in May, triggering concerns for other regional banks like First Horizon and PacWest, which reported a 9.5% drop in deposit value. In the face of the contemporary financial landscape, it is wise for individuals to ready themselves for the potential occurrence of analogous crises. Current economic indicators are raising alarms, with an upsurge in corporate bankruptcies, escalating debt levels, and apprehension surrounding lending and loans. Higher interest rates. Elevated rates are a two-pronged catalyst for a U.S. credit crunch. The Federal Reserve has lifted interest rates to as high as 5% from almost zero 12 months ago, the steepest jump in the United States borrowing costs since the 1980s to rein in surging inflation. The higher rates have played a part in Silicon Valley Bank's demise by slashing the value of its bond portfolio, and also have fanned fears that other mid-sized and smaller lenders face similar risks, causing a flight of deposits. About $1 trillion in deposits have been withdrawn from the most vulnerable American banks since the Fed began hiking interest rates this year. Warnings from Wall Street. Major financial institutions like Goldman Sachs and other Wall Street banks have raised red flags regarding the implications of the Federal Reserve's policies. Their primary concern revolves around the impact of rising interest rates, which have significant ramifications for the broader economy. Rising interest rates can squeeze profit margins and lead to cash flow problems, exacerbating the risk of meltdown, as has been evident in the increasing corporate bankruptcies during 2023. Lending and loan issues. Banks have responded to economic uncertainties by tightening lending standards. They are becoming more cautious about lending to businesses and individuals, which is making it difficult for borrowers to access credit. This is especially challenging for companies, particularly those that rely on loans to manage their cash flow or expand their operations. Certain sectors, such as real estate and healthcare, are particularly vulnerable to credit stress. The real estate industry, for example, has seen an increase in bankruptcy filings, which can ripple through the economy. The healthcare sector is also feeling the impact as credit stress seeps into the labor market. Bank savings and reserves. In anticipation of worsening economic conditions, banks have been significantly increasing their reserves. They are setting aside substantial sums to cover potential losses associated with these defaults. Major banks have notably bolstered their loss reserves. For instance, Citigroup doubled its reserves, and Morgan Stanley quadrupled the funds allocated to cover potential loan losses. These actions effectively drain money out of the economy as the banking sector stockpiles reserves to prepare for challenging times. The United States government has introduced new capital rules for large and regional banks. These policies are designed to restrict business access to credit, with the initiative known as Basel III Endgame. It forces banks to increase their money reserves by 16% when issuing loans to companies without exceptional or excellent credit ratings. However, the challenge lies in how banks will be meeting these requirements when their money reserves are dwindling due to account holders withdrawing funds. Debt crises. The government invested at least $5.1 trillion to stem the banking crisis. That's more than one-third of annual production. It also increased the country's debt. The national debt is hitting a record level. During such crises, investors become concerned that the country will not afford to pay the bonds and that it will default on it. That happened to Iceland in 2008 and threw the country into bankruptcy. Debt default has also bankrupted Argentina, Russia, and Mexico in modern times. While Greece was bailed out of its crisis by the European Union in 2010 to stave off a greater effect, it has since repaid only a fraction of its loan. This crisis is the significant factor in bankruptcies in the United States. Retirement concerns. Bankruptcies are adversely affecting retirement plans, potentially leading to delayed retirement, asset depletion, and long-term financial challenges. They are depleting an individual's savings and retirement accounts. Funds in a retirement savings account are usually exempt in bankruptcy, but if you withdraw those funds, they lose their exempt status. For example, if you withdraw funds and deposit them into your general checking account, they are no longer exempt. This is true even if you deposit the funds into a separate account. Vulnerabilities related to the banking space. It's clear with hindsight that several banking sector vulnerabilities were building up before 2023. These include the battered banks having significant exposure to speculative investments, focusing on excessive risk-taking, and issues related to interbank money lending freeze. These problems made it harder for the banks to cover withdrawal requests. Plus, it even opened the systemic risk bottle, unraveling every kind of threat along the way. Risk management and control failures. Banks mostly always operate in risky waters, and that brings us to the importance of risk management. During the 2008 financial crisis, one element of risk management was religiously trolled, evaluating the creditworthiness of the borrowers. In 2023, there is another risk control and management blunder causing overexposure to long-term debt securities. Government response. The American government has established bankruptcy laws and a court system to oversee proceedings. These cases are filed in federal bankruptcy courts, and the process is governed by the Bankruptcy Code. This legal framework provides a structured way for individuals and businesses to resolve their financial difficulties. Critics have expressed concerns that government interventions, such as stimulus packages and bailouts, are creating moral hazards. They argue that these interventions encourage risky behavior by individuals and corporations, knowing that the government will come to their rescue during economic downturns. This moral hazard is leading to repeated cycles of financial crises. Political gridlock and delayed responses to economic crises are further exacerbating these issues, underscoring the need for improvements in the government's approach to addressing bankruptcies. Impact on United States economy. One of the most immediate and severe consequences of banking crises is an increase in unemployment. As banks struggle and businesses face financial challenges, they are resorting to cost-cutting measures, including layoffs and job reductions. Many companies become more cautious about hiring new employees during such crises. They are freezing hiring and reducing the number of job openings, which is making it challenging for job seekers to find new opportunities. Other than impacting the job market, these effects range from the immediate threat of deflation due to consumer and investor risk aversion to potential longer-term inflationary pressures. The growing stress in the banking sector has boosted the odds of a United States recession within the next 12 months. The bank now believes that the American economy has a 35% chance of entering a recession within a year. Assessment of the impact on businesses and individuals reveals clear concerns like limited access to loans, reduced investments, especially in high-risk assets like stocks and cryptocurrencies, and widespread business uncertainty due to lower consumer spending. Role of technology and social media in the 2023 banking crisis. Both social media and technology had a role to play in blowing up the United States banking crisis. The modern era has seen global banks connected to each other for capital, and with regional, albeit major American banks failing, a large part of the global financial machinery felt the tremors. For the unversed, some of the basic pieces of tech responsible for interbank communications include SWIFT and cloud computing. Also, it is noteworthy that several tech startups, such as Roblox and Roku, had exposure to Silicon Valley Bank, making investors lose trust in the entire sector. Even cryptocurrencies came on the radar of experts, with some suggesting banks' exposure to blockchain-driven assets as the reason for the meltdowns. Social media also added gasoline to this entire fiasco, with experts and influencers posting their random theories regarding the crisis. All that worked right into the feedback loop and furthered the fire. Comment down below on what you think, and leave a comment if you find value in the content we do on this channel. Hit the subscribe button for all the latest updates, and we'll see you in the next video.